Good afternoon, everybody. This is Jeff Scott. As you can see, it's 12:13 on Sunday, July 22nd, and this is my top-down review. I like starting with my background here because this reminds me, especially in this time of year, that there's nothing wrong with taking profits. Sometimes you just get lucky. My birthday is January 31st. The market peaked on like the 29th, and like 2 days earlier, I cashed out some profits this year after a great January, mostly because of Netflix, and bought a boat. And like I said, sometimes taking profits is good because we're still just getting back to those highs at this point. Speaking of Netflix, I entitled today Earnings Roulette. And as you can see from the screen, in the lower left-hand current corner, and I'll come back to that, there are a lot of earnings this coming week. We're going to still have the Trumpster. We're still going to have tariffs. We're going to have Putin. We're going to have Playboy bunnies and strippers and all the other mishigas that we get out of this president. But I think earnings are going to matter. And by the way, in case you missed it, he sort of did the big taboo. He started trying to manage the Fed down on interest rates. So interesting week with the president. And so I call this week Earnings Roulette. If you don't like the sound, guys, hey, people complain every once in a while. I get it. I don't like bad sound either. I don't know if that helps or hurts. Where it was. I do this for free. No one pays me anything. I actually use an external mic. I think part of the problem is I mumble. I also think some of the audio drivers kind of screwy on this machine. So unless people want to buy me a new machine for my videos, I'm just going to wait until I recycle this out and it's good old time. As always, for education purposes only, I'm a doctor, not a broker. I'm independent. Nobody pays me to say good or bad things about them, and trading involves risk, and you alone are solely responsible for any decisions you make. I will talk about options some today, so let me specifically call out options are considered risky, and I refer you to the Options Industry Council for their very sage advice. When I do live training, and there probably will be one at the end of the year, I'm still waiting to hear back whether there's one in Orange County in October, November as well. I like to refer to my training as be your own guru. You can pay some guy to tell you every day what he's buying, or you can figure out how to do it yourself. And I think becoming your own guru is how you make money. I started with CanSlim. CanSlim's been approved by Morales and Catcher and others. Ian Woodward, may rest in peace. What a brilliant man. He's the one that really set me on fire from an investing perspective. He's the one that taught me about being your own guru. This is Ron Brown. He's another, both paid in his case and volunteer in both of our cases, educator when it comes to HGSI and teaching people how to use the program. We both use the program. We use it differently. That's one of the beauties of HGSI. It's not one specific way of using it. George Lee, someone who I have the opportunity for frequently to spend the time on the podium with, great guy, good friend. And over to the right, let me try to get my mouse so it doesn't keep doing that, is my buddy John Person. John, he's very similar, not a CanSlim guy necessarily, but buying stocks, futures, options, but mostly a swing trader on his own stuff. Author, has got some great indicators, has become a friend. Van Tharp, the god of position size and money management, and then Sager here from Superior Profit, who's got some interesting, innovative, and in my feeling, non-copying for most part, where it's different. It's independent of most of the things that I do, and therefore it actually adds something, not just repeats things I already have, especially his automatic trend line drawing and TradeStation, which is just bizarre how accurate that's been. What I need on my desert isle, I kill my desktop because you'll just wonder why I have so many programs. I need TradeStation and Thinkorswim. Right now I am pissed at TradeStation. They did a weekend where they forced an update onto 10 onto your computer, and then when you start it, it goes in and updates, and I just get into a continuous loop. I have to actually reinstall version 9. So much fun. Thinkorswim, great program. And then for analytics, HGSI and EdgeRater are my keys. This time of year, I do spend time with my seasonality programs. Not a promotion or advertisement here, but really just to tell you, you get a free 30-day trial of HGSI on the website. And man, my mouse is very touchy today. I apologize for that. They have a free 30-day trial up here. They don't even ask for a credit card. And under investing strategies, you'll see a series of webinars or videos by Ron and I that should be helpful as you learn the program. Stock patterns are cyclical. This has been a tough year. We ran up to this side very early, especially in the S&P, and we've just barely gotten back to previous highs. Now, what has happened is we haven't really pulled back much either. It's just every time it looks like we break out, we pull back. So we've taken the top 20%, 10% of this curve off, and we've sort of been in a Darvas box with an upward trajectory. And you always keep wondering, when are we going to break out to higher highs? Perhaps we've done that now, or when do we going to fall over? And, you know, the sell in May thing doesn't seem to work, but markets usually peak right after July options expiration, which was this past Friday. So something to think about. So as I get more concerned, as I am getting more concerned that we're more at a top than at a bottom, although that would be on short term. Long term, I'm still very bullish. I'll probably be a little bit more defensive, and I'll talk about that with my Amazon approach in a few slides. Looking at the market on Friday, mixed at best. There was, the markets were flat on the week. Had I not done a defensive play on Netflix, I would have had my lunch handed to me. I was long 3,000 or 30 calls, which is 3,000 stock at a 305 strike point, and I made some trades on Monday, which I'll talk about. Where were things hot? Look at consumer staples were all green, while utilities, which have been strong, were red. Foreign markets, actually, which have been weak, were green. Is that because of the dollar? Maybe. And notice there was some green on the gold. Regional banks and big banks started working this week. I'll look at Bank of America at one point as a stock that I think is potentially viable here. So let's go into my Thinkorswim because I think you can see it better when I use that. I use the right one. So this are the, should be daily, but I wait for it to boot up. Here it comes. And if I just go into, we'll look at them one at a time, I think. So these screens are easy to construct. It uses some indicators that I give out at my live meetings from Bob Meager, which he graciously supplies. Let's see, make this a full year. There we go. So you can see that this is the E-minis, the futures of the S&P 500, and you can see it peaked here on January 29 and has yet to reach those peaks again. So if you are mostly trading S&P 500 stocks, you've had really a sideways market. As I said, it's sort of been a Darvas box type of a market. Oh, don't do that. That's not what I wanted. I wanted to do this, and I wanted to do this, and all right, I did the wrong study. It's been a sideways market with an upwards trajectory. Channel, that should be a trend line. I guess I use it. There we go. There we go. So you could almost look at something like that, and maybe look. That's not it. And then potentially something. Now we're in that kind of a channel, so we're going up. Although of late we're in, whoops, don't want to do that. Hit this again. Of late, we're more in a channel that looks like that. So we're in an upward channel. We're at the highs of this channel. We actually have failed it here back in June. We failed it here. So, would it shock me to see this market come back to the 2750 range and test the 50? No. Would it shock me to come all the way back and test down here the 2715 range? No. So if I look at this, what do I see? I see a market that is not yet back to the previous highs. I see a market that's in an upward channel, and it's at the top of the channel. So it wouldn't shock me to see us soften for a few weeks here. So I'm a little concerned in the short term, but as I said, longer term, I'm much more optimistic. The NASDAQ's different. Let's go to a daily for a full year. The NASDAQ, if we do the same thing with the trend lines, I screw this up, but you get the point that the NASDAQ is kind of at the top of its trend line as well. But unlike the Dow, the NASDAQ is an upward wedge, but it too is at the top of its range. So would it shock me? No. Low of the year occurring in the NASDAQ, August 21st of 16. The high on this was just now. So we took out that January 29th high here, was taken out earlier in March, and again here just a couple days ago. So NASDAQ stronger than the E-minis, but like the E-minis at the top of its range. The YMs, let's go to a year's worth of data on this as well. So they peaked January 29th. And if we look at it today, it's weekly, sorry about that. Still peaked on January 29th, and very much reminiscent of the S&P 500. But if there is such thing as a trading range here, it's in the midst of its trading range as well. Now, is there a head and shoulders forming here? I don't know, but that's a possibility. And again, this is the type of time of the season that I might expect some weakness from the major markets. The IWMs, all over the place this week. And as you can see, they peaked on the year at the end of June and have gone, sort of in a consolidation period here and a little bit of a triangle. And, they had a strong day on Thursday, gave back some on Friday. Over the last couple of days, the other ones are starting to roll over. These ones still an upward trend. So I guess the small stocks have been short-term, have been leading. The VIX had a PPS buy signal, interestingly, come in on Wednesday, but it's still below the 200-day moving average and kind of in the choppy area that it's been. And then the dollar had a sell signal, and this is where on Thursday it started getting talked down by Trump, and it continued to sell off on Friday. Now, on the dollar specifically, let's take a look at a weekly chart. And you could see on dollar futures, this 200-day moving average, it's rising, which is bullish, I guess, but the dollar has just failed so many times to get back above that. Now, we'll look at the UUP at some point, and I think you'll see that the UUP, it looks a little different, and that's the cash ETF, not the futures market. And just very quickly looking at the weekly on the markets, the NASDAQ set a weekly high this week. Again, the E-minis and the YMs set it earlier this year. You got Doji here, Doji on the YMs, the Russell, the strongest of late. And then you can see the dollar futures. We talked about that already. So I start with that. Then I like to look at some of the other things, and we'll go back. Well, we'll just look at the slide presentation for now. It's faster. Rates actually popped up this week on the 10 and on the 30. So despite the fact that the Trumpsters started trying to talk down the Fed, we did see the rates pop. And rising rates are good for banks, especially regionals and insurers. And I did see that on my Friday review. In fact, REITs, MLPs, utilities, dividend payers, and home builders, although they've been strong, some of these seemed weaker on Thursday and Friday. Now, a lot has been made of the flattening yield curve. This is not a shareable slide. This is a slide that I picked up from somebody else, and when somebody gives me something and says I can't share it, I don't share it. But what it's looking at is a 3, 6 month, 1 year, 2 year, 5 year, 10 year, 20, 30 year treasury yields and their change over time. But more importantly, it's looking at the blue here, which is the yield curve, and as it flattens, people are getting concerned. I've read all kinds of things. The interesting thing when I look at it, and pink is the S&P, and I've said it before, when does the S&P roll over? It rolls over when you start to come back up, which means you're raising the short term. When does the S&P fall over? Not when I went flat, but when I started to go up. When does the S&P roll over? We'll see. AD lines. Now, when I look grossly at this, at the 2000 Russell, 2000 on the left, and the 1000 on the right, I really don't see much of a rollover. There's a little bit of a stub your toe at the end. And again, here's the NYSE, and you could see a bunch of major markets, and a flattening of the AD line certainly hasn't rolled over. Bonds turned down, perhaps because of the yield rising. But there were some softening in breadth. You don't see much here. Stocks above the 200, they turned down just a little bit, as did stocks above the 40. But if I look at my 3-month new high, new low, we did come down quite a bit. So there has been some softening in breadth, but nothing major. The daily McClellan, we're kind of at a high here. So we've been going up, and we've been going down on the McClellan oscillator on the daily and the summation index. That suggests there might be some underlying breadth problems. So signs of perhaps there's maybe self-fulfilling prophecy that we're going to take a pause here as we go into the time that the big money is probably going out to the Hamptons. I'm doing fine here in Palm Beach County, where it's hot, it's sunny, and I get to go out on my boat and play golf. Don't need no freaking Hamptons. Current buckets, 2/3 of stocks in the S&P 1500 are above the midline of their Bollinger Bands, but very few stocks are above the Bollinger Band, so bullish and not extended. There's been no Hindenburg sighting since June 21st on the NYSE, much longer on the NASDAQ, and as you can see in here in green, the new highs on both are high, but the new lows are low. You need to have 2% on the new lows, 2.2% for you to be close to getting a Hindenburg Omen. And those who've been following me and followed Ian in the past and others know that the Hindenburg Omen, when you start to see a series of them firing, it's time to be concerned that a major correction is coming. So I'll be spying for those, and they're built into my charts as well. Market tone. Let's look at the Woody indicator, which is this where my arrowhead is. And we're mostly green here, and we'll continue to hope to stay green. That's a bullish sign. And if we look at the Woody indicator applied to sectors, you can see that it's mixed, but mostly green with a couple that are neutral. Now, one of the things that you can do at HGSI and other programs, I'm sure, is to put together a synthetic index of your favorite stocks. So I put together, Ian put together, and we've maintained the canaries, which, and obviously Priceline is now called bookings, which is reflected in the chart. But you can see that the canaries, which have been the FANG stocks plus a little bit, I think Tesla, well, I don't have Tesla in this one, but Netflix got hit this week. And Baidu's been somewhat weak over the last month or so. You can see that they're consolidating at the 17-day. It's not really weak, but it's certainly not showing me energy momentum that's about to break out to highs. I'll probably retire this index today. This is an index that I put together before the 29th. It was put together on the 21st of leaders. And then as the market peaked, it rolled over, and its breakdown really predicted what we saw in the market. So it started rolling over before we got to the 29th. And that's, is why we put these indexes together as an early warning signal. Now, you notice it's just going sideways below the 50, certainly not bullish today. And I think that reflects market rotation from past leaders into potentially new leaders. Now, I put this slide up again, and let's talk about it for a few seconds. This is a massive, massive week for earnings. It is not every stock that's going to hit, but it's some zingers. And these will move the market, they'll move your portfolio, and then add to that, although he started to become more friendly to the market, Jerome Powell speaks on Tuesday and Wednesday, and every time he spoke in the beginning of his tenure, the market sold off. There's jobless claims, and there's the usual Baker Hughes report, some production numbers, and EIA petroleum status reports. But all in all, News is a little bit softer this week, but earnings are not. And again, don't forget about Powell. Just look at what we have here. Halliburton and Alphabet on Monday, TD Ameritrade, Illinois Tools Works, plenty of good things. Bank of Hawaii on Monday. Tuesday, you got AT&T, you got Texas Instruments and Verizon, United Technologies, Teradyne, Lilly, Kimberly-Clark, Chubb Insurance. And then we get to Wednesday where you get Boeing, AMD, Coca-Cola, Facebook, Visa, PayPal, Align Technology, the clear braces people, Gilead. And then Thursday, Celgene in the morning and Amazon in the afternoon. Healthcare for in the morning, but for me, Amazon by far my largest holding. And that'll be a big day for me. CMG, they must be loving it. McDonald's has the problem now with the gastrovirus or toxin, used to be CMG's issue. And then Friday morning we got AbbVie, Merck, Exxon, Chevron. Boy, there's no let up here. So I made this quote a long time ago. I didn't take it from anybody else, but it's not that unique of a quote. I'm sure other people have thought of it too. It is a judgment call whether or not you hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So I'm going to skip this for a couple of seconds, except to say, as I mentioned, Amazon is my biggest holding, and come Wednesday or Thursday, I've got to figure out what I'm going to do. My cost, I bought, and I talked about this at my educational programs, I bought Amazon, I bought 40 calls and sold 40 puts at 480 a couple of years ago. So I did a synthetic long position, and then 10 days later it broke out. The puts expired worthless, and those calls have been propelling my account ever since. I have some calls still that I've just rolled forward that are deep in the money. I have some long stock, and I'm going to have to figure out how to manage this. Has it peaked here? And like the market, is it due for some softness? So I'll come back to this and how I'm going to manage as Amazon. Let's talk a little bit about Netflix. I don't know if it's skill, if it's luck. It's probably a little bit of both. I thought Netflix was going to fool people and actually go higher with earnings. I got it wrong. But somehow, when I put it on the Discord, I still made money. So I owned a week ago 30 Netflix September 305 calls that were deep in the money. So for those that don't know options, that meant I had the right but not the obligation to buy Netflix for $305, and I had 3,000 shares covered there. Now, since Netflix was trading at 400, you know that I would want to buy those. So they were each worth $95 a pop. So going into to earnings, I was nervous. So I looked at everything. We talked about it last week. I didn't think I had a big edge to stand pat. Yet I wrongly still was bullish on the stock. So I decided to play it safe and keep skin in the game. I sold 20 of my calls for, I think, $77 plus some premium. And there was a lot of premium there, even though they were deep in the money. And I took profits on 2,000 shares worth of calls. I kept those 10 calls in case the stock ran. Well, unfortunately, the stock was back down to the 360s. So those calls got hammered. What I did to protect myself is I sold 10 430 calls for $14 or $15, which limited my upside to 447. And then I did a very wide iron condor for 20 contracts that generated another in credit, another $10,000. So I was able to buffet, and actually I did more than 20 contracts actually. I was able to buffet my loss. Now, if you look at what happened to Netflix after earnings came out, it dropped in the 340s. So I went to sleep thinking, all right, I'm going to lose this much. I'm going to lose. I was going to lose money on the condor. But crap happens. It opened at 347, traded as high as 385. My short 430 calls and short 430, 440 calls basically are worthless. So that was all profit. I looked at my 370, 360 put spread, and it was at in the 347 range. It was about $10, very little time in it, which meant I got paid for something I was going to lose. So I looked in, I saw, I could roll it out a couple of weeks and get paid more money for it. So I did that, put some premium in my pocket. And then next thing I know, Netflix moved above 380, and what I bought for $10 was now worth about $2, $3, and I basically took profits and sold it. So at the end of the day, even though my long calls dropped about $30, $40 a call, I ended up making $2,000 on the position. Why? Because here is a case where selling premium on calls out of the money, on condors, and then later short a credit put spread. What I ended up doing was generating enough dollars that made up for my loss. So sometimes options can be used as protective strategies. I know that was fast. I'm going to come back to the end and talk about Amazon. So market thoughts, and then I'm going to pause for a second. Markets finished near flat on the week. Rates and dollar pressure late in the week by Trump continues to flame fires of controversy. Time to prepare for some market-moving earnings reports. Will the bull finally take the summer off as we enter a week of quarterly reports? I think we're going to slow down. I do think the market will end the year higher than we are today. I'm still very bullish long-term. And seasonality typically predicts a softer market after July options expiration. So let's go on to the charts. All right, I am resuming this after my wife just made me a beautiful lunch. I actually had to revert back to TradeStation 9.5, which doesn't sound like a big deal, but I have a zillion indicators, and getting the first one rebuilt took me some time. So just very quickly, let me just look at the major markets. And let me just add the, oops, that's not what I wanted. I'm sorry. Here's what I want. So we'll start with the E-minis. And, people who follow me or follow when I used to look at this a lot know there's 5 or 6 things I look at. Number one, is it in a PPS buy or sell? It's in a buy. Number 2, what color is the paint bar? Green is bullish. It's an Alexander Elder indicator. It's okay to be buying or holding. Red is bearish. You should be holding or selling. And blue is neutral. You can do whatever you want. It's an impulse indicator. Third thing, I'm looking for evidence of divergences. And those red dots are bearish, and green dots underneath would be bullish. The fourth thing I look at, where am I at within the auto envelope? If I make a big move above or below, I probably revert to the mean. Then I look down here. Where am I sitting on my high jump bar? If I go back to January 29th, notice where that high jump bar was when we maxed out that week. That high jump bar was at 100%, and the high jump bar predicted that we'd fall, and that was January 26th at 100%, and that's basically was a signal to get out. And then lastly, I look at the weekly bongo. Is it green? Is it red? And it's green right now. This is which is the middle one of these 3 dots. This is my weekly in a buy and my monthly in a buy. So slowing down, topping process perhaps, enough that it's still bullish, but to me it's slowing down. YM, the Dow futures, looks almost the same without that divergence there. Blue, but a green buy signal in all time frames, and red on the weekly bond goes a little weaker. The Russell futures, I said, they've been the strongest on this way up, and you could see that they are in a buy, blue, with the divergence. You could see even on the weekly, they're above the auto envelope, and unlike the others, their high jump's pretty high. Back on the June 6th, it got to be 100, and it's traded sideways since then. It's come down, though, to 88. And lastly, the NASDAQ futures, very similar above it on the weekly on the auto envelope near the top and pulling back some here, and at 69. So the strongest has been the Russell and the NASDAQ, the E-minis and the Dow, perhaps a little bit weaker. as I look at this, I do have concerns. Is this market ready to take a pause? I'm not saying to drop heavily, but is it time to pause? The dollar got a daily sell signal on Friday. That's probably meaningful, and that's probably a lot being talked down by Mr. Trump, President Trump. And oil, which had sold off here, was the sell signal, actually got a new PPS buy signal on Friday. So we'll see if oil doesn't rebound. So saying all that, let's take into HGSI and let's look some more at this market. I like to always start in the designer, and then I want to find my major market analyst groups, Major Markets Plus, and then I hit the warehouse button, and they should open up over here. Perfect. And they'll be ranked here on price and volume, and that's the T1 top-down analysis view. And you could see with raw combo ranking, the transport, small stocks, industrials, composites, biotech at the top. Interesting mid caps in the S&P 500 and the Russell 2000 at the lower part, along with the bonds. That's interesting. So that shows sort of a divergence in the market, perhaps favoring small stocks. Well, not really, because you got the Russell down here. It's interesting. This is heavily dictated by one day. If I look at a 5-day performance, volatility was up, semis were up, small caps were up over 5 days, and what was down was oil, silver, gas, TLT, and NASDAQ 100. All right, so let's just take a look at our usual things. And again, this is repetition. That's what I do. I do it myself when I do my analysis. And I've been doing the same of looking at the markets for a long time. So I tried drawing these in Thinkorswim. You could see I was thinking the same thing here. We did get a new high on this leg, but we haven't gone up to the trend line here. Does this look to me like it's rolling over? It's not rolled over yet. It's still above the 8-day exponential. I just see a market that to me looks like it's losing momentum, and we're in a time of the year where I expect the market to potentially take a breath. Not roll over, take a breath. The Dow Jones Industrial Average being pushed high by transports. Again, is this a head and shoulder pattern? Don't know, but we're nowhere close to breaking it at this point. But just like the S&P, I see weakness there. Look at the NASDAQ composite, and it's a different pattern. It's still going up, although it seems to have softened the last couple of days just a teeny bit. Is it time for a pause to refresh? I'm not saying this market's going to tank, but I don't see a lot of momentum that's going to push it up real fast either. And then the Russell 2000, obviously earnings can make a difference. One thing about the Russell, although it's been super strong, we're right up against resistance. The good news is you can break above resistance. But again, on all these major markets, I see reasons to think that we need to take a pause here. And maybe we've got a couple of weeks of a pause coming. The dollar cash market traded off on Friday after the Trumpsters' comments. Volatility, as we saw earlier, it picked up some, but it's still running into a conglomeration of moving averages, which will be resistance. And then if the dollar was weakening, is gold going to pop? I don't know. So many times gold's run up and it struggles and falls at the moving averages. Right now, gold and silver are in a pretty terrific downtrends, but you have a little reversal pattern here if it can continue. I'm not buying it yet. So that was the indexes. I might do the same on industry groups and look at how many groups to the upside. I've only got 38. How many groups to the downside? I've got 30. So that's significantly weaker than it's been. All right. So let's look at what's up at the top. Steel, oil, banks, biotech, banks, equipment, entertainment, rail, tobacco, pharma, airlines. So the first one that pays dividends that would like a low dollar, rising rates should not be good for midstreams. And they were down on the week. So that's kind of interesting that they made it here. So we may go take a look at them. But steel raw materials, look at Cleveland Cliffs. This is what's driving it. I don't know if it was earnings. Let's take a look. So what we can do here is we could put this on my stock view here. And let's do a right click, info from web, FinViz, and what will it tell me? Like magic, it goes right to Cleveland Cliffs. Earnings and sales beat estimates. Now, Bible gap up, that's here, met the requirements. Out of a squeeze. Somebody knew something. Out of 4 days, you had 3 kahunas, and it's a stock that's trading at $10. Look at the projected earnings per share coming in. If you add $1.24 in the next 2 quarters and you've taken out 62 cents, you're adding 62 times 12, $7. I think the stock can go to $16 or $17. I like it here. This was a powerful move. I certainly would not let the price drop much below 9. You're going to have to buy it closer to 10. But I like Cleveland Cliffs here, and I'm going to throw that into my buy watch. They already be there. Should already be there. Interestingly, it was the only one that was above the index. And although this is an interesting pattern with the kahuna, I don't like buying things that are down on the bottom. So that's certainly not a growth stock. So Cleveland Cliffs looks interesting. Integrated oils. Now, if you're doing your analysis and your order is different, it's probably meaning that you may have updated it since I last updated this. But all in all, things are going to be pretty close. Now, I've always struggled with Petrobras, but it had a big move. It's had a big move off the bottom. Perhaps, the politics there are getting better, but look at the earnings per share growth coming into this stock. We're going to drop 11 cents, and if we make the earnings, we're going to add 73. That's plus 63 cents. Even at the multiple was 12, that's $7.20. So there's a lot of potential oomph coming into Petrobras. Petrobras, I think this is Argentina, looks similar. Remember, they've had significant corruption there. Now, I actually maintain a substantial position in Ecopetrol. It pays a 2.9% dividend. I bought it and talked about it back here in October, November, when it had its first breakout. It's been a great performer, great earnings per share continuing. And I like this here. It's coming out of a squeeze. This might be interesting as well. So integrated oils, especially, those are all foreign. Chevron has earnings this week, so I think I want to be careful here, perhaps. Let's see if I do this. Earnings are on the 27th. So it'll be Friday. And 3.7%, great earnings per share growth. If it wasn't for earnings, I might be more interested. It's sitting right on its 200-day moving average. So integrated oils with oils firming. Banks. This was one of the first weeks that I saw a bunch of regional banks looking interesting. A lot of this is one that's been beaten down. This was not one of the ones I liked, but it had a big gap up on Friday, and that's why it made the list. Look up these SunTrust. Now it's a nice pattern. It's kind of loose, but breaking above the 50 with a kahuna. Everything green up here. That looks interesting. Sideways pattern. PNC's further down. These made my buy list. Let's see if I can remember what they are before we. Rates struggled on Friday, but it's sitting right underneath the 200. That's what I'll be watching. Huntington sitting on the 200. All the different places that you might expect them to bounce, a bunch of pocket pivots on Synovia. So they don't look great yet, but they look like they might be setting up, and we'll revisit these when we do my top stocks. Now, I will say that this was not my week of finding hundreds of great setups that I can't figure out which one to buy. There's so many. I struggle to find great setups. Now, this is one that had a Bible gap up. That's interesting. PTC Therapeutics. Now, it's been an uptrend. Something happened on Friday. Doesn't make money, so it's one of these well, it's got some earnings, revenue, so maybe it's not preclinical. Let's see what we can learn from the web on FinViz. And what did it say? So they're buying a couple of other biotechs, and they're going to sell some shares, but the market seemed to like it. Something's interesting there. That's a nice pattern. You were in an uptrend. You had a nice gap. You broke through the PSAR reversal. Kahuna, mobile breakout from a squeeze. That looks interesting. Viking Therapeutics had a big move up as it looks like it's ready to go again. Mobile breakout from a squeeze and a Kahuna. No revenue. Gilead, hard for me to get excited here. They've been struggling so long. Biogen IDEC had some great Alzheimer's news coming into earnings. I probably would be a little bit leery. Coherus Bio, they popped up on some good news, both of their own biosimilar product, but also on some positive things about biosimilars from the U.S. government. They're looking for a approval on a drug like Neulasta later this year. And you could see on Wednesday they had a Bible gap up, mobile breakup from a squeeze in Kahuna, and they're continuing to go up. I've liked this in the past. I do work with them, so I can't really buy it. I think it still looks interesting. All right, anything else here that pops out at me? You know, a month ago, I was talking about United Therapeutics, and it broke out nicely here. It's had a nice couple of days as well. And I think Vertex was the one I was pushing a little harder, VRTX. Let's see if it's here. That was what I was thinking about, not United Therapeutics. Vertex, VRTX is more closer to 50 if I remember correctly. Yeah, this one had a nice gap up as well. So biotech can work for you. I still worry about the Feds and pricing. But here's LABU, which is another way of playing biotech, which is a 3X. It's a loosey-goosey one, but I've made money on this in the past. I'm currently out of it. In biotech, I'm playing Celgene. I'll have to decide what to do before earnings. I'm up a little bit. And I'm also playing, I still have some of my ARQL, but it did not do well. Pulled back and a little bit of Peers, which looks like it might be setting up. But sometimes playing the ETF is not a bad way to go. Now, I mentioned we visit Bank of America. Bank of America doesn't pay much of a dividend anymore. I think it's 1.2, 1.6 now. Good earnings per share growth, driving revenue, and look what it did. It popped here above the 200. It retested and held. Your 8 days coming up through the 200. Here's your 17. Your 50 is sitting on the 200. They had a pocket pivot on Friday, a mobile breakout. I like buying great stocks at support. I think this is a good place to be buying. Bank of America pays a 1.6% dividend. You could buy JP Morgan, looks equally as good, pays a 2% dividend. I think Wells Fargo, which isn't as clean in my mind, actually pays a bigger dividend, WFC. I'm not a giant fan because of the screwing around that they did with accounts. And it's sitting right on the 200 as well, pays a 2.8% dividend. So big banks are looking interesting. I also like Bank of Montreal. I think Banco Santander. Bank of Montreal, again, sitting right above its major moving averages, pays a 3.7%. And Banco Santander, let's think of something else. We'll find it when we look at my buy list. Number 6, medical equipment. You know, it's funny. One of my friends who manages a little bit was visiting with me, and he told me about, or was listening to me do a review, and I talked about one of the stocks on this list. And his partner, which is his son-in-law, had bought somebody, forgot to tell him where he heard about it. Here's Align Technology. So if you're on the phone, Chris, gotcha. And it broke out back here in May. This has been just a high-flying stock. I think they do the Invisaligns. One of the dentists I played golf with this week, to protect me at work, I won't tell what day, just assume it was Saturday. That's a good day to say. He told me that the nice thing about this, as well as a regular dentist, to do what an orthodontist does, which I guess the orthodontists probably don't love. It looks like me, it's setting up to run again. I just have a hard time. It's got a huge multiple to growth rate. It's an expensive stock. It's got earnings this week. Busy week. Transcentrics, don't know this company at all. Cheap stock. Looks like it's breaking out. Catalent, it actually looked better on my John Person stuff, but you kind of got a saucer, fry pan bottom, whatever you want to call it. It looks like it's trying to break out. And then this is the one, if this is my pick of the year by far. I was sitting, and I've talked about it before, in March and April. I bought it in April at a meeting in Orange County. I talked about it, and sometime around March 9th or April 9th, I did it on my webinar. The reason why I bought it, I called it a Jesse Stein pick, where it's been basing forever, and now it's starting to have volume come in, and it's starting to move. It had this kahuna here, which was a pretty big trigger. And then here on the 10th was a big volume day, which was the time to get in. And doesn't have earnings per share growth, which is a bad thing. Does make some revenue, and it's now trading at 27, and it looks like to me, it's setting up to go again. That's been my pick of the year by far, and I bought a lot of it because it was cheap. Entertainment content, not a group that I have a whole lot of interest or insight in. I see John just posted his weekly thoughts. But here's Billy, and it's shown up a lot on my scans the last couple of days, but it's an IPO, still trade below the 50, so I'm not going to touch that. Disney, they're in that acquisition craze right now with bidding war. I don't like buying it when I see this kind of a shooting star, but it's going to be a winner in that acquisition game. Lionsgate, too low in the pattern. The problem this weekend was not a weekend of finding great stocks that jumped out that said buy me. CSX had earnings last week that were great. This is the company that popped on news of a new CEO not long ago, that the CEO died. But look at the earnings per share growth picking up compared to the multiple. Revenue is starting to grow with oil being where it's priced, where it's at. These trains have plenty of work. And look at this pullback to the 50. I just wasn't watching it. A squeeze, followed by a mobile breakout and a bobble gap up, kahuna and a pocket pivot. This would have been a great time. It's still not too late, perhaps, to buy CSX. Kansas City Southern, sort of a flat pattern, and then a bunch of kahunas and a break. Union Pacific has not broken out yet. Norfolk Southern looks like it's running as well. It's funny. I don't own a train stock per se, but I do own Greenbrier, which services trains and also makes them. And this thing broke out with the CXX and some of the other news as well. All right, so I screwed up. So let me go back to this. Industry groups, warehouse view. Come on. Perfect. I'm not going to look at tobacco being a cancer doctor, but I will look at specialty pharma and airlines. Mirati has an interesting pattern. Uptrend, sideways, breakout. I'd rather be breaking out on the 50, but a kahuna broke through the PSA or not, mobile breakout from a squeeze. This one looks interesting. It is preclinical. Something happened on Friday. Let's see what happened on Friday with Mirati Therapeutics. Added to the Russell. Not a lot of news. The Russell is June 25th. I might keep an eye on Mirati. This is a very interesting pattern. I like it. Choppy. Yeah, I look at something like La Jolla. He's just going sideways. One of these days they're going to work. We work with them, so I'm not going to comment much on that one. And then airlines, and then I'm going to finish here. Airlines had good earnings, some moderation in oil costs, but more importantly, their PRASM is going up, passenger revenue per mile flown, but also they're reducing capacity, which means they can raise prices. So United Continental broke out on Wednesday. Azul. Just look at the others that we might be interested in. American down in the dumps, Delta, Southwest. Spirit? I forget what Spirit is. That's not Spirit, is it? No. I don't know what Spirit Airlines is, but let's see. Right now, United Continental is one that looks actually reasonable to me right here. Let's look down here. Spirit. So I'm sure as I went through this, you saw a lot of stocks you want to buy, not Spirit's kind of sideways too. I mean, that's sort of indicative of my review this week as I went through, looked at hundreds of chart patterns, and I just didn't have many come up, slap you in the face and say, Jeffrey, you need to buy me right now. Because that's what I want to find. I want that tandem. I want the stocks that only can go up from here. So let me show you, break out the industry group, and I'll call out some of my favorites. So I mentioned some of the small banks. Here's some of the ones I like. Popular, that's the one I liked. POP. And you can see, why did I like Popular? Because uptrend, sideways, mobile breakout from a squeeze, pocket pivot, Kahuna, Bongo. Great earnings coming in, pays a 2% dividend. I like Popular. SunTrust, similar pattern, breaking out as well. TCF, not yet, but will be one to put on a watch list looking for an intraday breakout. So I did like some of these banks. I showed you already, I think PTC. Let me show you PTC. PTC looks interesting. They're the ones I think that did the acquisitions. Or no, they didn't do the acquisitions. They had some data. Let's see. More info from Web. Yeah, they're the ones who are doing acquisitions. At Bible Gap Up or Gap Up, Mobile Breakout Squeeze, Pocket Pivots, Kahuna, if I ignore this mess right here, I really want to be buying this stock. This shouldn't make me more bearish. I just wouldn't want to buy it the next couple of days there. That one looks interesting as well. Going down the list from a retail perspective, it's hard to imagine I actually like a department store, but uptrend, sideways, pull back to the 50, momentum coming in. This is Kohl's. It's got great earnings per share coming in. I liked Kohl's. Going down the list, there were a couple of REITs I liked. Most of them have to do with, hotels. Here's LaSalle. Why do I like it? Uptrend, sideways. Kahuna's coming in, mobile breakup from a squeeze, pays a 2% dividend. We'll look at Pebblebrook as well. Pull back to the 50, Kahuna. Great earnings per share growth, 3.8% dividend. And then anything else? And then I guess we'll look at the last couple. Callaway Golf. I used some Callaway drivers. Uptrend, pull back to the 50, had a Kahuna, mobile breakout from a squeeze. This makes me nervous, but I learned a long time ago in HGSI, looking out multiple quarters. The only one that really is valid is the first quarter because these numbers are subject to change. That looks interesting. And in the deal group, I like Nucor here. Why do I like Nucor? A Kahuna off the 50, mobile breakout from a squeeze, great earnings per share growth, pays a dividend. X is a little, I currently have some X, but X is, looks similar, it just hasn't broken out yet. I like Nucor, I like its earnings per share growth. So this is the list of stocks that intrigued me, and also in the retail place, Tapestry, I liked. So, and then for those that like living dangerously, Momo has been a stock to be out of, and it's sort of sitting at a place that I like to buy it, pull back to the 50. But this goes into my list as a pullback waiting for a signal. And I break these down here, and we were looking at Momo. And I just like to see some momentum coming in, but that's when I'll be watching. Why? Because last time it did this for me, it popped. And it ran up from 36 to 54 before it came back down. So those are some of the things I liked. Now let's go back and let's talk about Amazon and what I'm interested in doing. So the first thing I want to do is I want to go to Thinkorswim. And this is an important line here on Amazon, AMZN. Because the first thing it tells me is the market is predicting a 92-point move in the next 5 days. All right, so now let's open up a chart and let's confuse everybody and bring in another program. Bring my programs up. Options Pro, you don't have to be a VectorVest customer. It's just to me, it's a great options program. I'm sure much of this can be done with the analyze part of Thinkorswim. I just like this. So, all right. So let's start with this, and let's change this to Amazon daily graph. Look at this. This is 2017. This has been a double. Almost. Well, it's been a double. No wonder my portfolio looks so good over the last couple of years. So let's stretch this out a little bit. What it's told us is, let's see if I can do that. Okay. Amazon is at 1830. So I want to do a horizontal line. I never draw on this, so here I am going to look like an idiot. Add study, probably not going to be on that. So I want a drawing tool. Somewhere there's drawing tools here. Here they are. Too many programs. Crosshairs. All right, it's got to be right in front of me. How do I do a horizontal line here? Oh. No. Hold on a second. This is embarrassing. There's got to be a horizontal line. Profit line, fibs, linears, raise, auto scale, line. Nope. Well, let me stop this and see if I can't find it. All right, so if I add 92 to 1813, so 1913 would be a 1905. So somewhere in this range is the anticipated up move. If I subtract 92 from 1813, 100 would be 1713, 1720. So the market is predicting that I'm going to stay in that range. So what is it that I can do to protect 1,000 shares of Amazon? I'm just going to use 1,000 because the math is easy. Now I'm going to go back into my PowerPoint for a second because I thought about this already. Here is the seasonality of Amazon. Actually, what the heck? Let's go into it in full size. Sorry if this gets lengthy, but this is how I think, and I think managing my Amazon is probably the most important thing. So here's Amazon in a significant uptrend. Shocker, huh? Now the bad news is at the top of its channel, and it really could pull back down here, which is 1770, and then bounce. And in yellow, I have 10-year seasonality, and in green here, I've got 5-year seasonality. So over 10 years, it just goes right into this channel. Over 5 years, it lags a little bit. So it's in the channel. Channel's an uptrend. Notice that my stronger seasonality kicks in back here in August. August 10th to September 20th, it's up 9 out of 10 years, but it doesn't have a guarantee it's going to be up over the next 30 days. So my edge longer term is there, but I don't feel like this is a home run. Now, I tightened it up some. Let's see if it's still in here. I don't see it. So if I just look at here, here's the pattern. One would expect it to come back down. And notice this yellow line, that's a 10-year seasonality prediction. And we're good until we get into September. So here it looks like not quite perfect. It's positive, but not anything that would make me so sure that I'd bet the farm, kind of like Netflix was. Magenta Trader is another program that does seasonality. Just take a look at it, what it shows for Amazon. And let's put on the variable scanner. So it shows the weakness here, and then starting in later August, it shows some strength. That's not home run strength here. And the fact that I'm up at the top of the trend line, it makes me a little nervous to leave my Amazon unprotected. And what did I say about the market this week? So I think the market's going to soften. So let's figure out what can I do. So let's say I assume that Amazon's going to stay in this range. Let's start now looking at options here. So let's look at Amazon. What things would I consider based upon my concerns? I could buy a put. Buying a put would say, at the strike price, I'm locking in my price. Now, I could do a bull put spread, which means I'll sell a put further out of the money to reduce my costs, but it limits my protection. I could sell something very far out of the money and collect premium like I did Netflix, which would be a bull put spread. Maybe I want to go short the stock here and lock myself in a synthetic short stock. Or maybe I want to generate some premium by selling a bear call spread. So those are the things that I come up with. And then I could do now I'm not going to do a strangle. That's expensive. All right. So these are the things that I came up with as ideas that I could do. So let's start. Let's look at what happens with a bear call spread. In a bear call spread, I am going to go back to my chart, and I'm going to say that in a bear call spread, I'm going to bet that we don't get up in this range. So if I sell a $1,900 call and I buy back, say, a $1,920 call, then I'm basically way out of the money. And so a bear call spread would look like this. And I want to be, if I sold, let's try and make this realistic here, because I would sell, and I'd probably give it 2 weeks, not on August 3rd, say a 1,900 bear call. And I would buy back a 1,900 and say 20 call. Okay. So what that's basically telling me is, as long as the stock trades, all right, this is current prices here at 1815. As long as the stock stays below that 1,900, I'm going to make money on this trade. My break even is 1905. Problem is, I'm only going to get $500 for every 10 or 100. This isn't a lot of money. I'm going to basically collect $5 for every share. Now think about it. I'm getting paid to sell a call up here above the price that we think the stock's going to move, and then buy something here to protect me so I don't get beat up, and I'm going to get paid $5 for carrying that risk for 2 weeks. That's kind of what I did on Netflix for one of my legs, because if stock's going down, that's going to expire worthless. All right, what about on this side? Can I sell a put below, say, a put at 1710 and buy back a put at 1690? This generates some more free money. So a bull put spread. So we're going to sell a put spread at, we said 1710. So we're going to buy we're going to edit this. I'm going to buy a put at 1690. And I'm going to sell a put at 1710. And we're going to set it for August 3rd. Perfect. So what does this tell me? This tells me as long as the stock stays above $1,706, I'm going to make money. And I'm getting paid $4 for taking that trade. So for every 100 shares of Amazon that I want to protect, I can generate $9 by selling a call spread here, which generates $5, and high likelihood I'm never going to get there. And I've capped my loss here at how much? I think $20. And I'm selling a put spread here for over $4, and I'm risking 20. So I'm collecting $9 for every share, and I'm risking $20. Now the good news is, odds are I'm not going to go in either of those zones, and I'm not going to be in both places. So the most I can lose is $10 on that trade, and the most I can make is $9. So I will probably do those trades to create some money. So I'm going to assume, and we know that we put together the ASS of assume. It's not a pretty term. I'm going to assume I got $9 credit there. Now, that's not going to help me if the stock drops $80. So what else could I do? I guess I could buy a put at $1,810, but how much is that going to cost me? And the problem with that is it's going to go to zero very quickly. So if I bought a put at 1800, it's 1815, the problem is it's got to drop. It's so expensive. It's going to cost me $62 a put that it's going to have to drop until 1752 before I actually make any money. So I'm going to lose $60 per share even before my protection comes in. That's crazy. I don't like that. So, and odds are the price, this will expire and I'll lose money on it. In the old days, this is what I used to do to protect, and then the stock would move up and I would sell this back at a loss of $20 or $30. I don't like that. How about selling a call against it? All right, let's say that I'm going to sell a call at the money. Now, the beauty of the call is, and that's buying a call. I want to sell a call. Hold on a second. We're going to go short a call. So I'm going to sell a call at 18, and I'm going to get paid $60. Okay. So what does that mean? It means that as long as the stock stays below $1,880, so that's a $57 move, I make free money. I make $60. The problem with that trade is what? That's correct. The problem is it doesn't protect me more than $60 to the downside. So that's another consideration. What if I do this? What if I take synthetic short the stock? Oh yeah, let's remember, we're buying, let's make these 10. Let's do some editing here. We're going to buy 10. We're going to sell 10 calls. We're going to buy 10 puts. But remember, we already own stocks, so we already own 1,000 shares. So I'm going to put 1,000 shares. Okay. And now what's going to look like? That's too pretty. Something's wrong. Let me take a look at this. Buy 1,000, sell a call, buy a put. Okay. Well, something is screwy, because let me think about this for a second. The fact that I'm going to be selling a call means I'm short a call and I'm getting paid $65. The fact that I'm going long a put means I'm protecting it. So if the stock goes up, I will get called away. If the stock drops, since my net out of pocket on this trade is basically nothing, I will be protected on $1. So I don't know why it did this. Let's take this by, oh, I know why I did, because I bought 1,000. I need to only buy 100 because I only protected. All right, so I'd have to do 100 of these and 100. Yeah, that should be correct. Hold on a second. Somebody else want to do 100 shares. No, that's not right. So now I want to add edit, and I'm buying 1,000. Because what should happen, all right, I give up. I can tell you basically what I would expect when I do this. If I do this trade, and maybe it's looking like this because it has me spending the money, I am committing myself to give away my stock if the call trades up. But I got guaranteeing myself $65 a month side. And I'm using that 65 for the put. So there's no way I can lose money on this stock. I don't gain any money either, all right? I'm locking in my current profits. It's costing me nothing. Now, what happens if the stock drops? I'm protecting my bottom side, and that call will go to zero. So what I think I'm going to do here, and I don't know why this is looking so bad. I'm sure I did something wrong. But if I take that out, you see that if the stock drops, I make money. And if the stock goes up, I lose money. But if I have a long position overlying this, it goes up equally to the calls. I'm flat to the long side, so I will neutralize my loss. So I'm guaranteeing my bottom line. So I apologize for screwing that up a little bit, but I'm doing this at almost no cost. So let's go into my Thinkorswim. And so what I'm likely to do here then, after just convincing myself, will be a series of trades. I am going to protect myself here because I am very worried this market's going to roll over. And I'm going to look out to say August expiration. And I am going to do I guess, not really a straddle or a strangle because they're not the same direction. I am going to sell a put at $1,815. And I'm going to buy a call at the same strike price. Actually, I got that wrong. Hold on a second. I am going to buy a put. I'm going to sell a call. And I hit the wrong button. So I'm going to sell a call. I'm going to buy a put. And what's going to happen, I'm going to get paid $2.30. So if not, and now I have money in the bank. Now, if my stock goes up, then if the stock goes up $30, then I'll be called away at the strike price of $18.15, or I could buy back that call for that $30. So I'm the upside, every dollar that my call loses, the stock will make. The downside is I'm buying protection at my price. Now, there's other things that I could do. I could come in here and say, all right, let's just buy something back that's up here at $1,900. Because maybe I don't want to, there's a point where I want to cover that naked, that call. So I could come here and buy this, sell something to pay for it, say out another $80. And this is going to be, hold on a second. All right, I'm probably getting too crazy for you. Buying the 1815, this is a buy. So now for 20 bucks, what I've done is I've protected my downside 100%. I've risked $80 of upside that I'm not going to get to win on. But if it moves up more than $80, if we have an outsized move, I'll still get to capture everything above that 80 points. There's a lot of different things that I could do. So bottom line is, and I'm sure I've confused you, I'm going to do a lot like I did with Netflix, but I'm going to buy a put at the money. So just in summary, and I know that that was confusing. If you come to my live meetings, we'll spend a lot more time. I'm long Amazon. I've got concerns regarding the tax. Therefore, I don't want to sell it right now. Not that it's long-term or short-terms. I've already taken 7 figures of profits this year. I don't want to take another 7-figure additional profits. I'd rather lock it in and wait a little while before I have to pay the taxes on that. If I own only options for Amazon, I don't care about taxes because they're all short-term gain anyways. Market expects a 92-point move. My considerations would be take my profits. I'm fine with that. Sell options against my position, generate premium by selling calls against my position. I could do that by selling out of the money calls. Protect my position with a long put. It's expensive. Sell premium outside the expected move, which were those verticals I started with and iron condors, or do a combination. And as I said, I think the combination I'm going to do is I'm going to sell a call and buy a put with the money from that call at the current strike price. That gives me 100% downside protection. The worst thing is the stock moves up $100 and I've got to buy the call back for $100. I'm going to give myself plenty of time to do that. And then I'm going to sell some spreads out of the money, both calls and put spreads, developing a credit, which will help pay for the money I'm going to have to write if there's an outsized move. On that note, we just had a brownout here, and I guess my generator actually works because I still have power. On that note, I'm going to say goodbye. I'm sorry if I confused you at the end. Let's put it this way. Options can save your butt. Are options risky? Yeah, options are risky. Fortunately, this is being recorded, and it's not necessarily live, and I'm not sure how long it's going to take to get internet back. But we had a brownout here, and I have a generator because we have hurricanes. And generators are great. The lights just got brighter, so it's probably coming back on. But buying puts are expensive. Premium evaporates. But I've devised a series of spreads here that will allow me to protect myself at a cost of limiting the upside. No one loses money by upside because the stock goes up equal to the calls, and I just either buy back the calls or let my stock go. But the bottom line here is, to me, options are protecting me, and that even though many people like to tell you how risky options are, and again, I ask you to refer to the OIC, here's a case where options are going to guarantee protecting my profits. Goodbye, everybody. Have a great day, and sorry for the confusion at the end.